Welcome to our channel. Today, we're diving into a strategy that takes guts but can be incredibly rewarding. Contrarian investing. We're talking about how to make money when everyone else is losing their minds and potentially set yourself up for life-changing returns. That's why today, I'm breaking down the best times to buy during a market crash. We'll cover market psychology, specific indicators, and strategies I've used to capitalize on downturns. So buckle up, hit that subscribe button, and let's get started. The first step to successfully buying during a crash is understanding market sentiment. The market is driven by two things, fear and greed. During a crash, fear is rampant, and everyone is selling their stocks like it's the end of the world. This is where you have an opportunity to be greedy when others are fearful. To gauge this fear, look at indicators like the VIX, also known as the Fear Index. Are headlines screaming about the impending doom of the stock market? That's a sign that sentiment is overly negative, and it might be a good time to start looking for deals. It's easy to get caught up in the hype and panic of a market crash, but this is where you need to be disciplined. Successful contrarian investing isn't about blindly buying anything that's cheap. It's about finding great companies that are temporarily undervalued because of the market's irrationality. Look for companies with strong balance sheets, consistent cash flow, and a competitive edge in their industry. Market crashes often create incredible opportunities to buy shares of amazing companies at a significant discount. Think of it like Black Friday for your investment portfolio. Blue-chip stocks, dividend aristocrats, and industry leaders often become incredibly undervalued during times of panic. Remember, we're looking for quality, not just cheapness. Don't put all your eggs in one basket. The importance of diversification. Even during a market crash, you never want to put all your eggs in one basket. Diversification is key to managing risk and maximizing your returns over the long term. Spread your investments across different sectors like technology, healthcare, consumer goods, and real estate. Consider international diversification as well. Beware of value traps. Not all cheap stocks are good buys. While market crashes can offer great buying opportunities, it's crucial to be aware of value traps. These are companies that may appear cheap on the surface, but are actually facing serious structural or financial challenges. Do your research and make sure the company has a clear path to profitability and growth. Patience is a virtue. Why timing the market is a fool's game. Trying to perfectly time the bottom of the market is nearly impossible, even for professional investors. Instead, focus on a strategy called dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the market price. Extreme fear. When panic selling creates once-in-a-decade opportunities. Remember that fear index we talked about earlier, the VIX? When that thing spikes to extreme levels, it usually means one thing: panic selling. Investors are dumping stocks left and right, often without even considering the underlying fundamentals. This is when you can find some of the juiciest opportunities. Valuation metrics. Finding screaming deals when others are fearful. During a market crash, pay close attention to key valuation metrics like price to earnings, price to book, and dividend yield ratios. These metrics can help you identify companies that are trading at significant discounts to their intrinsic value. Use these metrics to your advantage and scoop up shares of great companies at bargain prices. Policy announcements. Recognizing potential turning points in the market. Keep a close eye on announcements from central banks and governments, especially during times of market turmoil. Announcements of interest rate cuts, quantitative easing programs, or fiscal stimulus packages can often signal a turning point in the market. These policy interventions can inject liquidity into the system, boost investor sentiment, and spark a recovery. Stabilization signals. Knowing when the coast is clear to start buying. While it's impossible to perfectly time the bottom, there are certain technical indicators that can suggest the market is starting to stabilize. Look for signs of reduced selling pressure, such as declining trading volume or a decrease in the number of stocks hitting new lows. A break above a key resistance level can also signal a potential shift in momentum. So there you have it. Those are my best tips for navigating a market crash and coming out ahead. Remember, contrarian investing isn't for the faint of heart. It takes discipline, research, and a long-term perspective. If you found this video helpful, please give a thumbs up, subscribe to the channel for more investing insights, and hit that notification bell so you don't miss any future uploads. The best time to invest was yesterday. The second best time is today. Now go out there, make smart decisions, and build the financial future you deserve. Happy investing!